Hey everyone, I started tracking MTR last year when government announced the National Green Hydrogen Mission. It's a small cap engineering company with very interesting business around clean energy, especially hydrogen, the nuclear power, space and defense segment. I remember covering MTR last year when it was trading at around 1700 and company was growing at a very fast rate with FY23 sale growth of 78% year on year and profit growth of 70%. While doing my research, I stumbled upon one of the interviews of its MD who mentioned that they can potentially grow 5 times over the next 5 years. In fact, management guided for nearly 45 to 50% growth in FY24. Obviously, it was a compelling growth story. But every business has opportunity as well as risk. And that's where MTR on one side has a lot of potential, but there are a couple of challenges or key risks that could be an antithesis for company's growth. The reason I always discuss key risk in my analysis is because business is always very dynamic and unpredictable. While today everything may look great and company outperform, things may quickly take U-turn. Vice versa, today the company might be struggling badly but can eventually turn around. That's why it's important not to marry a stock and very important to track the performance of the company, especially when you have invested your money. And accordingly, take a call on holding it or increasing stake or reducing stake. Now in case of MTR, things were going very well till Q1 of FY23. As a result, company share price touched high of around 2800. However, in last couple of quarters, company has started facing challenges. As a result, company share price that zoomed around 87% in first half of FY24 corrected around 38%. However, there is some recovery in share price. So in this video, I've tried to decode the latest development in MTR. I'll cover the reason behind jump in share price and then sharp correction. Moreover, management has given the latest guidance for FY24 that also I'll share with you all. And I would like to cover both positives and negative of the company in an unbiased manner. Finally, I would like to give my viewpoint on what can be done with MTR. But this video is only for education purpose where my intent is to share my knowledge. I expect you to do your due diligence before taking any call on buy or sell. Alright, let's get started. So let's start the discussion with the beginning of FY24. Things were going well for MTR, where in Q1 of FY24, it posted year-on-year revenue growth of 67% and year-on-year profit growth of 20%. And in Q1 of FY24 Concall, management gave the growth guidance of 45 to 50% in revenue and EBITDA at 30%. Since company was growing at a fast rate and growth guidance was also very strong, MTR share price zoomed 87% to touch levels of 2800. In the meanwhile, MTR promoters were consistently selling stake. Especially in June 23, there was heavy selling from MTR promoters. It further continued in September 23 as well. Now the biggest question was, why promoters are selling their stake? Especially when MTR has so much of growth potential. Obviously, promoter selling stake is never considered good. It shows that they themselves don't have confidence in company's future. However, during that time, MTR was growing at a fast rate, so I did not pay a lot of attention to it. Moreover, promoter selling is not always bad. Sometimes promoter does QIP, that is qualified institutional placement, where FIs and DIs buy stake from promoter. So when promoter sold around 7% stake in June quarter, FIs added stake from 2.5 to 4.2% and DIs also slightly increased their stake. However, public holding also got increased. Also, when promoters are selling stake, the important question is, who are the promoters? Are they part of board of director or senior leadership team? Or they are some distant relative of promoters or inactive promoter who have received shares via gift. As long as board of director or senior leadership is not selling stake, it should not be a concern. So I did some background check and found that majority of stake sale was from promoters that are not part of core team of MTR. Basically, MTR started as family owned business and hence there are many third generation family members that are considered as promoter and they sell stake time to time. Moreover, in Q1, company's performance was top-notch and FY24 guidance was on track. So I did a video showing my confidence in the company. However, in Q2 result, MTR posted year-on-year revenue growth of 32.5% and profit degrowth of 16%, which was much lower than expected levels. On top of that, management revised their FY24 guidance from earlier expectation of 830 to 860 crore top line to 670 to 700 crore. And EBITDA guidance got reduced from 30% to 26%. Such a steep decline in guidance was a shocker for the market. As a result, its share price also started falling. Now, when you look back, on one side, promoter did heavy selling in June month and then Q2 results were also poor. It obviously raises concern because as a retail investor, we don't have insider information. We tend to rely on management guidance. Now, ideally, I like companies where management under-promises and over-delivers. I don't like companies where management over-promises and under-deliver. Until Q1 of FY24, MTR was under-promising and over-delivering. However, in Q2, management sharply reduced their growth guidance and share price also started falling. The question was why management went wrong on guidance. Moreover, was it a temporary blip or a long-term concern? So in Q2 result Concall, management clarified that this is due to the deferment of shipment plans against the confirmed order in the clean energy sector for the next fiscal year, which has impacted our growth in the short term. However, we anticipate a healthy long-term growth as we are expecting significant inflow of order in the second half of the year from new customers as well as existing customer, which will enable us to maintain our closing order book around 1400 crore to 1500 crores. So in spite of reducing the guidance, management sounded optimistic for FY25. In the meantime, its share price kept on falling because of revised guidance and its promoters kept selling stake. And recently, MTR posted its Q3 number, which was a disaster. Company sales fell down 26% and its net profit tanked 67%. Now, for a company that was growing at 45-50%, such numbers were very shocking. But interestingly, management shared that growth guidance for FY25, where they have guided for 45 to 50% growth in FY25. Although MTR share price tanked right after Q3 result, but it has shown some recovery after management FY25 guidance. The biggest question after the disaster Q3 performance was, what went wrong so badly in Q3? Moreover, as per management guidance, FY24 revenue is expected to be 670 crore to 700 crore, and so far in 9 months of FY24, total revenue of the company is 440 crore. So how is Q4 going to pan out? Would they fall short of the revised guidance of FY24 or would they achieve it? And more importantly, what gives management the confidence to grow by 45 to 50% in FY25? So I went through their latest con call to get the answer. But before that, I want to highlight the key risk with the company that I have also mentioned in my previous video. So first biggest risk with the company is high dependence on a single client. I have been talking about this risk from day one. MTR's single biggest client is US-based clean energy producer Bloom Energy. Although MTR has a diversified business across defense nuclear space, but major revenue comes from clean energy, which is their biggest growth area in my opinion. And that is also reflected in company's revenue. Clean energy contribution has increased from 50% to 77% in FY23 and majority of their revenue comes from Bloom Energy. So to an extent, MTR growth is linked to Bloom Energy growth. The major concern is that as the clean energy segment contribution is increasing in MTR business, company's dependence on Bloom Energy is also increasing. Any negative development on Bloom Energy can significantly impact MTR performance. In fact, this is the major reason for underperformance of MTR in FY24 because their order for FY24 from Bloom Energy got delayed. Now it's important to understand Bloom Energy. So Bloom Energy is one of the largest player in hydrogen technology in US and every country in the world is investing in hydrogen technology as a source of power. Since Bloom Energy is investing significantly in advanced technologies at operational level, company is reporting losses. Now that US is facing tough time due to high interest rate, it is clearly impacting Bloom's prospect. Company share price has fallen more than 75% since the peak in February 21 and company has deferred some order for MTR to FY25. Now going forward, MTR performance would depend upon two things. In the short term, how much order it receives from Bloom Energy and more importantly for long term, how MTR reduces its dependence on Bloom Energy. Because that would be a key factor in deciding what valuation MTR would command. We'll discuss it shortly. Now second risk with the company is high working capital business. MTR is highly capital intensive business that requires huge working capital. Company is sitting on huge inventory with inventory days more than 500 in FY23. Moreover, its payment cycle are also quite long. Hence, its cash conversion cycle is quite long. In fact, on cash side, company is hardly generating any cash. Now, cash is certainly the most important aspect of a business, but sometimes high growth companies keep investing the money and compromise with cash flow in the short term. But there should be a clear plan to eventually start generating cash. The good part here is company does not have too much debt where it faces challenges to even pay its debt. Its debt to equity is 0.38, which is comfortable. So these are the two key risks with MTR. Now let us look at the latest management guidance for FY25 and how they are planning to reduce both the risk of high dependence on Bloom Energy and high working capital. Moreover, in the latest Concall, there was a question on promoter selling that management has answered. So let's discuss it. First of all, for FY24, management has revised their final guidance to 610 crore, which is lower than their last guidance of 670 to 700 crore, and EBITDA guidance is of 24%. The major reason for sharp fall in FY24 guidance is due to order delays from Bloom Energy. Now, one of the key reasons for this delay is due to transition from one product to another. Basically, MTR is working with Bloom Energy from many years in clean energy space, where it is currently manufacturing hot boxes and electrolyzer. Earlier, MTR was supplying Yuma hot boxes to Bloom Energy, which is now transitioned to Santa Cruz, because Santa Cruz hot boxes are advanced version of Yuma with higher power generation capacity. Since this clean energy space is very dynamic and keeps evolving, such transitions are natural. However, going forward, management has retained their confidence in company's growth for FY25 with target of 45 to 50% revenue growth and EBITDA of around 26%. Interestingly, management mentioned that we have a very clear analysis done for a growth of 45 to 50%, about 900 crore of revenue for next year with 26% EBITDA, which we have considered in a very reasonable and conservative manner. The key reason for this growth is hot boxes division will be around 33 to 35% of company's total sale for next year. Moreover, management is very optimistic from growth in another segment, including space and aerospace. They mentioned that space and aerospace will move close to about 150 crore from current revenue base of 45 crore for next year. Next, coming to civil nuclear power segment, management mentioned that we are expecting orders worth 500 crore from KEGA 5 and 6 reactor, and the price bid for that hopefully should be done by end of February or March. So depending on the schedule of the price bid being opened, these orders can be looked either in this quarter or definitely in the first quarter of next financial year. Although this 500 crore order book is expected to be executed over the next 3 to 5 years, so it's not that entire 500 crore is for FY25. Moreover, in clean energy, company is trying to diversify to reduce its dependence on Bloom Energy, where company has highest exposure, and that poses the biggest risk for the company. That's where company is in the final stage of negotiation with multiple MNCs. MTR has already started working with another company, Fluence Energy, in clean energy space. In fact, management mentioned that hot box contribution of Bloom Energy would come down to 33% from 67 to 70% because all other segments are doing well. Now that is a great news. Like I said, this was my biggest concern and question around how MTR would reduce its dependence on Bloom Energy. And if Bloom Energy contribution would go down from 70% to 33%, it would be a great relief for the company and market would really appreciate it and shareholders would be rewarded. Now, if you look at space and product division, company mentioned that space is something which is going to go up literally by about 110 crore for next year. And product division also will do well, which you know for about 130 crore for the next year. So we have a clear segmented breakup for each of the revenue breakup for 900 crore, what we are talking about for the next year. Clearly, management has shown great confidence in their latest con call and clearly bifurcated their growth plan, how they are going to achieve 45 to 50% growth in FY25. In fact, like I said earlier, in clean energy, MTR is supplying hot boxes as well as electrolyzer. Now, this electrolyzer can be a key growth driver for the company because it is used to produce green hydrogen, which is methane free. In case you want to learn about green hydrogen, please revisit my last year video on MTR where I discussed about it. So coming to electrolyzer, MTR has not included it in FY25 growth estimate. Management mentioned that for the next year plan, the line reports what I spoke about, we have not included any of the electrolyzer for next year. So any order which comes for electrolyzer will definitely be an upside to the revenue what we are looking at. So we have done a very detailed analysis. We did not want to take any chance in our guidance what we are giving. So we have not considered any of those electrolyzers order which might come in for the next year. Finally, I want to discuss the management update on their satellite launch vehicle. I hope you would be aware that MTR is working with InSpace, that is Indian National Space Promotion and Authorization Center, where in 2022, MTR has received an order to launch its own small satellite. The timeline for this project is 4 years and company is in second year right now. MTR is also actively engaged with ISRO for launch of PSLV and GSLV vehicle. So this is the guidance for FY25. I hope you got a good sense of company's growth plan. Management also discussed the concern around working capital, where they said that there's an improvement in our operating cash flow, Last quarter it was 66 crore negative cash flow from operation, which is reduced to 26 crore during this quarter. While we have received a GST refund order on 30th December for about 35 crore, the amount was credited on 4th of January, which we have not accounted on 31st December. Had it been received on 31st December, our cash flow from operation would have been positive 9 crore. Our short-term debt is 117 crore as against 166 crore in Q2. A reduction of 48 crore has been done in this quarter. Our net working capital days are 302 days. If we account the GST refund of 35 crore, it would have been 280 days. So because we received on 4th January, we have not accounted in the Q3 result. So we are working on the working capital days. Wherever possible, we try to reduce working capital days, improve payable days, and try to achieve the working capital target reduction in the working capital days. So management acknowledges that working capital and cash flow is a challenge and they are working to improve it. Finally, the biggest concern that retail investors have, which is on promoter selling. So there was this question asked to promoter on that Mr. Srinivas company's MD mentioned that basically I don't have any control over it. But what I can say is that frankly I have not sold any shares. I hold the highest number, almost the highest. I am on the top 2 shareholders in the company. I truly believe in this company. The promoters also truly believe in the company for sure. But they are all diversified promoters. It's a 50-year-old company and they are different professions living in different parts of the world. But I think the promoters getting into the market will come down drastically moving forward. That's what the information I have. Finally, management concluded the con call by saying that our worst phase is done. We are back on track and whatever guidance we have given for the next quarter or the next year, we have taken in a very conservative manner with the experience what we had in the last 2 quarters. So in this video, I've tried to compile all the information I've gathered regarding MTAR. I've spent a good few days trying to collate all information from various sources, reading multiple con calls, understanding their business in detail, and tried sharing all the information in an unbiased manner. In case you are interested in company or already invested, I would strongly recommend reading company's latest con call that you can get it on Screener website. So if I conclude, FY24 was certainly an unprecedented year of underperformance, but FY25 is looking very promising with 45 to 50% growth guidance, and the best part is company is reducing its dependence on Bloom Energy significantly in FY25. In fact, management has mentioned it multiple times that they are actually very conservative in their growth guidance for FY25. So based on all the knowledge I have gathered, I would like to keep my confidence in the company. MTAR is currently trading at around 2000 rupee at a PE ratio of 75. This high PE is due to sharp fall in FY24 earning growth and currently share price is down around 28% from its peak. So if you already have a decent allocation in the company, I would suggest worth holding it. If you don't have MTR and looking to ride the clean energy theme, it can potentially be a good investment opportunity. At the same time, it's important to acknowledge the fact that still a significant portion of company's business from Bloom Energy that they should further reduce. And there are still challenges with company's working capital. Considering both the opportunities and risk, MTR at current valuation looks decent. Neither too expensive nor too cheap. If company can achieve what it has guided for FY25, I expect the share price to go up further. Any failure to achieve its guidance can result in sharp derating. So this is it for this video. It was a very interesting research for me and I hope you all would appreciate it. If you find it useful, do share it with your friends. And in case you want to join my exclusive community, there's a weekly series where I share one exclusive video every week that include important government policies and its impact on various sectors. Then I also discuss promising stocks and stocks I'm adding in my own portfolio along with a lot of other informative content. In fact, this week I would be sharing my own portfolio details. So you can explore the series on my website and there are many more informative videos in the pipeline. So stay tuned. I'll see you next video. Till then, take care.